Well, hey there, everyone. Happy Monday, July 28th, and welcome to the show. This is Chart This with Dave Keller. I am super excited to be here with you today doing the show. My name is Dave Keller, coming to you from a beautifully, wonderfully cool and sunny Redmond, Washington. Championship this morning for my son's club soccer team. Did not go the way we wanted it to. However, super proud of the boys for making it to the championship for their little division there up in Snohomish, Washington. So congrats to the side for playing hard. 3 straight wins going into the championship, which is pretty awesome. But we enjoyed supporting the club a great deal. Great to be here with you, though, checking in on the market. So I was sort of off on the soccer fields this morning. Was randomly checking the market behavior on my phone when the opportunity presented itself. But digging into it a little bit further here, preparing for the show. Nice late hour rally here. The last half hour really saved the day for the S&P 500, managing to get just narrowly into the green after spending most of the afternoon slightly in the red. So the S&P and the Nasdaq finishing strong today as we kick off a week of heavy earnings reports, heavy economic data, and the Fed meeting this week as well for July into August. Lot to talk about, so let's get to the charts and focus on how things played out through the course of the day today. As you can see here on the 2-day preview chart, Friday was a pretty strong update for the S&P 500. Earlier today, the S&P did briefly go above 6,400 for the first time in history. That was pretty much it. We rolled over from that point around 2 p.m. Eastern. We got just below 6,380. Nice rally in the last 15 minutes. Saved this market from being a first down day, I feel like, in quite some time. So the S&P essentially 1 point away from Friday's close. That's an unchanged day for all intents and purposes. The Dow slightly lower, the Nasdaq slightly higher, about 0.33%. Not a lot of movement here. It's not super surprising, to be honest with you. If you told me we're going into a week with a ton of earnings on Wednesday and Thursday, with a Fed meeting on Wednesday, and with economic data, I think the PCE data is on Wednesday as well. I would say Monday's probably a choppy, sideways, wait and see kind of day, and that's certainly what things felt like. There were some individual names and certainly some groups that had some decent moves today. We'll touch on a couple of those for sure. The VIX slightly higher, but again, S&P, NASDAQ, VIX, small caps, not a lot of change today. I think this is sort of a wait and see kind of moment. Rates generally moving higher today as bonds sold off. The TLT was down about 2/3%. That's a Treasury bond ETF that we like to follow. That means rates generally drifting higher, although the short-term end of the curve, slightly lower. 5-year, 10-year, 30-year points all up a bit. 10-year yield is just about 4.4%. The long bond yield just below 5%, but looking like it might eclipse that here very soon. Dollar up about 1% from Friday's close. Continuing to see a bit of a pullback here in precious metals. Silver was basically flat for the day. Gold down about 0.2%. The energy side of the commodity space, though, having a decent update with crude oil prices moving higher. The USO, which is a crude oil ETF, up about 3%. Energy ended up being the top performing sector today. Looking at cryptocurrencies, kind of all in the red. Bitcoin, I would say, generally still bumping up above that 120,000 level. Sort of have not been able to push above there here in the month of July. That is the all-time high. That's sort of where we're sitting, waiting to see if that breakout starts to come here at some point. Coming out of the weekend with something like Bitcoin and Ethereum that trade 24 hours, you wonder if it's, I don't pay a lot of attention to Bitcoin over the weekend. I try to not look at the markets as much as possible unless I have to. But looking at Bitcoin on a Monday, you wonder if we had sort of a nice rally over the weekend. Not as much. Sunday was a nice day, but today failing still to get back above that 120,000 level. Currently just above 118,000. But you can see all top 10 cryptocurrencies here on the stock charts platform, all in the red today. All right, looking at the sectors, not great in terms of sector breadth. Only 3 of the 11 S&P sectors finished in the green today. Energy up 1.1%. Technology up 0.8%. We'll come back to that. Consumer discretionary up 0.6%. This is 0.6%. Now, this is interesting because technology has been struggling here as of late. Other more value-oriented sectors, more cyclical sectors, as we'd say, have been doing much better. Technology has actually been lagging here in July, But today, having a nice, sort of leading move to the upside, outperforming the market. Consumer discretionary up as well, and consumer discretionary outperforming consumer staples by about 150 basis points. And so offense versus defense, very much still favoring offense. What we're going to do when we get to the chart review portion of the show, just highlight some of the charts that we feel are important to track here as the market continues to grind higher, continues to make new highs. What charts would you watch to look for signs of potential weakness? We'll highlight a couple that stand out to us. One of those using the XLY and the XLP for sure. So only 3 of the sectors in the green. That means the other 8 finished in the red today. Real estate, the worst performer, down 1.7%. Materials down 1.5%. Utilities and consumer staples both down about 1% today. Our market trend model continued, no change Friday with the strength that we saw on Friday's market. Continuing to see bullish readings on all time frames on our market trend model. One of the things, and I didn't grab this chart, but one of the things we would look for is the short-term model to turn negative. And that only happens if the price starts to rotate lower, which certainly we're not seeing just yet as we make new all-time highs again this week. Breadth not great today. And you can see on the New York Composite Index, 64% decliners versus 33% advancers. Those are, not bullish readings. On the S&P 500. 72% declining, 28% advancing. So, certainly breadth conditions had been decent in July and have shown some signs of strength. Today, kind of a weaker day. Most sectors down, most stocks down. Again, one day only, and not down a ton, but certainly seeing a bit of a potential reversal here in terms of breadth. Looking at the Magnificent Seven sort of leading growth names, we can see Tesla continuing to bounce after last week's gap lower on earnings. Friday kind of popping off of that gap level. We gapped down around $300 on Thursday of last week. Friday moving higher. Today moving higher again. We're sort of getting back toward that 335 range, which is where we had our most recent swing high in mid-July. NVIDIA, Broadcom, semiconductor stocks both continue to push to the upside, both up about 1.5+%. On the downside, you have 3 of the Mag 7 names in the red today. Netflix continuing to underwhelm after their earnings report a couple weeks ago, down about 0.5%. Alphabet and Microsoft coming down as well. Microsoft and Meta, 2 of the 4 Magnificent 7 names reporting this week. I think they're both on Wednesday. Apple and Amazon on Thursday. Big reports to try to make sense of it. I feel like this week could certainly be meaningful in terms of the data that we have to digest. I mean, those are just 4 of the earnings reports, but there are tons of S&P 500 names reporting earnings this week. A bunch of things to focus on, potential narratives that could emerge as we, start to hear more and more about, potential tariff impacts, inflationary pressures, forward-looking guidance, expectations, and how that's changing. So certainly that's one part of it. Fed meeting, PCE, the personal consumption expenditures, all coming through. By Thursday, we'll have all of that new information, and we'll see what the market does after all of that new incremental information to digest. I do see some questions and comments coming through on all the places we're streaming. We're live streaming right now on Facebook, LinkedIn, YouTube, and X. I appreciate you tuning in live if that's something you're doing. Great to have you here. I welcome your questions as we go. Anything we look at, any comments we make, charts we bring up, pop a question in. Anywhere where you can add a comment on any of those platforms, I can see that as we do the live stream, and I'll try to take a question or two at the end of the episode before we wrap the day. If you're watching the replay on our YouTube channel, just put a comment below the video with your question, and we'd love to answer it as part of our Friday mailbag episode. We had a great episode on Friday, by the way, answering some of the great questions we've received. I think 6 questions from last week, and some really interesting discussions that we were able to get into. So please check that one out on our YouTube channel if you missed it. Also, the Market Misbehavior podcast humming along very, very nicely. Had a great interview with Bob Pisani, who had about a 30-year run on the floor of the New York Stock Exchange for CNBC. He just stepped down from that role earlier this year. I immediately reached out to him, and he thankfully agreed to come on the podcast. Had a great discussion with him about his book, Shut Up and Keep Talking. Awesome, awesome title. The story behind that title is pretty entertaining as well. That's at the end of the interview. We also talked a lot about just investor psychology, about behavior of the markets. great anecdotes from being on the floor of the New York Stock Exchange for so many years, how financial media has evolved. So many cool just nuggets of wisdom, I thought, in that interview. So please check that out on our YouTube channel. A number of other great interviews here recently as well. I hope you enjoy. All right, looking at the market carpet, this is a heat map style visualization. Let's see how things are playing out here today. So, I mean, decent day. While the breadth was not particularly strong, like you can see, there's a lot of names that were up quite a bit today. It was one of those weird days where while the breadth was weaker, you look at the heat map and I'm seeing a lot of bright green, and it feels like the market should not be should not be as good. Now that was 5 days, so let me change that. I was going to look at that. I'm like, wow, that doesn't make any sense. I'm trying to talk as I see that. Okay, words of wisdom. Make sure you check the numbers that you have on the data. It's one thing I've learned. That's a great life lesson there about making mistakes. I tell you what, when you look at a chart and it doesn't quite look right, and something just feels off, I immediately start looking at all the details. All right, what time frame am I looking at? Do I have the right symbol? Do I have the right periodicity? It's like I'm doing something different. There we go. I changed that from 5-day percent change to 1-day percent change. This looks a little bit more like what I would expect this day to kind of look like, with a lot more red than green. Having said that, let's look for things that have stood out here. AMD continuing to move to the upside. Applied Materials, KLAC, On, Empower. These are a bunch of semiconductor stocks having pretty decent up days today. NVIDIA, of course, up almost 2%, but I mean, a bunch of these names doing quite well. Semiconductors have been lagging a bit here recently, and their underwhelming relative performance, I think, has raised some questions about their role as a leadership group. And I think with valid reason. I think that's a valid comment to make. Today, bouncing back higher a little bit, and NVIDIA, of course, making new all-time highs today. So don't get me wrong. There are plenty of charts looking very, very good. Now, what's interesting is within semiconductors, you have AMD basically going vertical. You have NVIDIA, which has been trending higher for quite some time, like Applied Materials. What else is another one in here? Like Lam Research. These are kind of pulled back recently, and that's been the problem in July, is while you have NVIDIA and AMD kind of going vertical, a bunch of the other semiconductor names have kind of pulled back a little bit and are not quite making new highs yet. But if they resume that breakout, pretty positive resolution to a pullback phase here. Also noting green in the energy sector. We grabbed one of these stocks, and to be completely honest, I forget if I grabbed Devon Energy or FANG, Diamondback. I think I grabbed FANG, but I don't know. I was grabbing a lot of charts there at the end. But energy having a decent day today. And that strength that we've observed in the energy sector has been noticeable. It's kind of hard to ignore some of the strength that we're seeing in energy. So let's keep focused on that for potential breakouts. Also in the consumer space, right? Nike, not a bad chart, right? Making a new 3-month high this week, and rotating higher, pushing $80 a share all of a sudden. Pretty encouraging. I think a nice upside follow through. Now that's all the good news. What's not so good news? I'm seeing a lot of red in healthcare. Healthcare has been one of the top sort of improving sectors. If just coming out of a soccer tournament for the weekend, if you had like the most improved medal, probably give it to healthcare in July for having some really decent, resurgence of potential leadership. Not a great day today, though. We're seeing some weakness to kick things off. Same with industrials. You have some random names like a Boeing making new highs, but industrials in general, kind of a quiet day today. And then all the defensive sectors kind of struggling here. Consumer staples, real estate, utilities, all sort of struggling here on a relative basis. So kind of a muted start to this week, although it was technically an up day, and you're certainly seeing some strength in key areas of technology, particularly semiconductors. I would generally paint this as a weak start to this particular week. Again, with a lot of inputs coming over the next 3 trading sessions. So for now, starting a little weaker than you probably would like. Let's see what happens as we gain this additional information here over the days to come. All right, before we get to the charts, I do want to let you know I am on the board of a music school called the Walden School. That's why I'm wearing a t-shirt for today's show. I attended this event a couple weeks ago, the Creative Musicians Retreat. It's about a month ago. It's a fantastic event based in the hills of New Hampshire, where musicians, composers, arrangers and educators come together and make music and get creative. They call it the music camp that changes lives. And it's a wonderful, wonderful place where kids, school age kids can come together for a summer camp of making music, of being creative, of supporting and challenging one another, experimenting with sound and creation. I think it's just a fantastic kind of a special place that in this day and age where kids have faces buried in screens and we worry about the upcoming generations, this is one of those good spots that I feel like I want to work hard to make sure that it succeeds. Today is Giving Day for Walden. They're doing a fundraiser today to help support the school and sustain it for many, many summers to come. If you had ever thought about, throwing me a tip or something, some sort of monetary something at some point as a thanks for any of the content that I'd put out there, I would encourage you, instead of doing that today, please go to marketmisbehavior.com/Walden or scan the QR code that you see on your screen. That'll go to their Facebook fundraiser. They also have one going on Instagram right now. Do whatever you can to help support that wonderful place. Again, I feel like in this sort of in this world with all the conflict that we have and all the challenges, this is a supportive, wonderful, positive place for kids to come together and make music. And I hope you'll join me in supporting them. Go to marketmisbehavior.com/Walden. And yes, I studied trumpet and voice as an undergraduate. I have randomly played my trumpet in random places, but at some point I'll do it again. I actually think when the S&P broke 5,000, I think I played trumpet on the show. I forget. It's a blur, but anyways, more to come on that. But thanks so much for supporting Walden, checking out their info at marketmisbehavior.com/Walden. All right, let's continue on looking at some charts. The market is strong, right? And again, this has been such a fascinating year. It really has. And I appreciate you allowing me to help you hopefully navigate this period. And one of the things that I get to do that many of you don't is that I get to actually share what I'm seeing and what I'm observing every day. And I can go back and see what I was saying on April 8th of 2025. And I could see if I was bullish enough, given the fact that it ended up being a major low. Probably looking back, I wish I would have been way more optimistic at that low. I was super skeptical going through the end of April, to be honest with you. And then the market trend model turned bullish. And by the beginning of May, I think you had to be pretty recognizing that the trends were quite strong. What's happened from May 1st to now almost August 1st is truly remarkable. And this is where I find being a trend follower is super valuable, because you don't have to worry about whether or not the market's going higher or not. You just follow the trend as long as possible. And we have a market making higher highs and higher lows. We have the momentum that is overall quite constructive. We're remaining above upward sloping moving averages. Those are all part of a bullish story, right? That's what a bullish chart looks like. And so, as we continue to make new highs, as we continue to pull back and find support at a descending 21-day exponential moving average, I think this chart is incredibly bullish. At some point, the uptrend will be over. At some point, we will stop going up and we will start going down. The severity of that move and the timing of that move, very difficult to predict ahead of time. So the best I think you can do is, number one, follow the trend and just keep a focus on the strength as long as that persists. And that's what we try to share with you, but also look for signs of potential weakness. And that's why we talk about bearish divergences and say, all right, here's a divergence we're noting. We noticed that about a week and a half ago and said, look, we're making new highs still, but we're doing on weaker momentum, potential warning sign. So if the market breaks below the 21-day EMA, that tells you, yep, most likely the top, you probably want to start thinking more defensively. If, on the other hand, the market makes new highs on stronger momentum, which is indeed what happened over the last week, that negates the bearish divergence. It basically says, nope, the uptrend continues to this day. And that's where we find ourselves with another new all-time high on an intraday basis on today, Monday, July 28th. So as long as the trend keeps going, as Paul Montgomery, famous technical analyst and letter writer, used to say, the most bullish thing the market can do is go up. We're going higher. So we're going to follow that trend as long as possible. We will encourage you to do the same as well. We will always have a wary eye on any sort of potential reversal. Now, a couple charts that come to mind here, and I'm actually getting ready to interview in about 45 minutes, Callum Thomas, who's the founder and head of research of a firm called Top Down Charts. He's actually a macro strategist based in New Zealand. So with the time difference, I'm going to talk to him here after the show today. It's tomorrow morning, so he'll be coming to me from the future Tuesday, July 29th, as we discussed. But I'll be talking to him about all sorts of warning signs he might be looking for because he's tracked this uptrend as many of us have. So, in preparing for that conversation with Callum here in a little while, I was just looking at some of the macro charts that come to mind for me. One of those would be credit spreads, which, to be honest, remain very, very narrow. Credit spreads are a great area of the fixed income markets to follow because bond investors tend to be very aware of potential risks, right? Their business, right? If you're investing in bonds, it's all about determining whether companies will be able to pay their bond coupons, right? Pay their debt back to shareholders. And so if they get the sense that companies are going to struggle, then they start to, credit spreads start to widen very, very quickly because they perceive additional risks. We're not seeing that sort of, negative behavior in the bond markets. We're actually seeing pretty bullish setup here with the high yield spread, which is that top section, continuing to be very, very narrow, less than 3%. Below that, it's the VIX, and these are plotted upside down here, basically tracking the trend in high yield spreads and also in volatility. The VIX touched 15 on Friday and finished the week just slightly below 15. And so overall, volatility remains very, very low. So spreads remain narrow, volatility remains low. These are the conditions that usually coincide with equity markets, risk assets going higher. So what would you look for? Number one, on this chart, you would look for spreads to start to widen, indicating bond investors are getting nervous. You look for volatility, the VIX to increase, suggesting option investors are getting nervous. You look for the S&P to start going down, suggesting equity investors are nervous. None of those things are happening, but this is a great chart we'll continue to follow to look for potential rotation lower. Here at this point, shout out to Tom McClellan, a technical analyst based here in the Puget Sound region of the Pacific Northwest. Tom's work and really his parents' work, Sherman and Marion McClellan, have become commonplace in many of our thinking, just thinking about breadth and macro indicators. Tom shared with me a chart years ago about the Fed when we were talking about whether the Fed was going to raise rates or lower rates. It was somewhere back in here. I remember talking to him. He said, don't worry too much about what the Fed's going to do. Just look at the 2-year Treasury yield. He said when the 2-year yield starts to go down, that's when the Fed's probably going to start to lower rates. They never have lowered rates really before the 2-year yield has started to go down. So the market kind of prices in the fact that short-term yields are probably going to come down. And then, so in this chart, and this is a long chart, this is going back like 25 years or so. The black line is the 2-year Treasury yield on a weekly basis. The red line is the Fed funds target rate. That's the Fed rate that we're talking about. So we can see that the 2-year yield tends to peak and roll over while the Fed rate is actually usually still going higher, or at least holding steady. And then once the 2-year yield comes down, that's when you finally start to see the Fed funds rate come down as well. So that was something that I remember talking to Tom about back here last year when we saw the 2-year yield starting to break down. And his comment was, yeah, the Fed's definitely going to start lowering rates here because the 2-year yield is telling you it's coming. What's happened, though, in the last 6 to 12 months is that the 2-year yield has actually been relatively stable. It's kind of hanging right around 4%, kind of fluctuating above and below there, but not really breaking down anymore. And so I think watching that, that I would say at this point, it's not really suggesting that the Fed's lowering rates just yet. Let's look what happens between now and that September meeting. Maybe that's the chart to watch there. So keep a wary eye on the 2-year Treasury note is the comment there. All right, Bitcoin continuing to languish right below 120,000. This is not a bad chart. I mean, arguably, this is still a very good chart in that we have generally, if you take a step back, we're making higher highs and higher lows. But in the last couple of weeks, we are no longer making new highs. We hit resistance around 120,000. And have basically been sitting there for the last 3 weeks. So, again, I think this chart becomes quite bullish if and when we can gain a foothold above 120,000. For now, sort of holding steady right below there. The momentum is drying up a little bit, but still okay. Again, this is still a good chart, but, failing to break out here. On the downside, you'll note I have the 10,000 increments highlighted. And I did that at 120,000, 110,000, 100,000. Look how often the market hits one of these big round number levels and then reverses. It's fascinating to me how this happens with a number of cryptocurrencies, but especially for Bitcoin. So not surprising at all, in my opinion, that we're stalling out at 120,000 because we stalled out at 100,000 back in the day in 2024. We stalled out at 110,000 just a couple months ago in May and June. Now here we are stalling out at 120,000. So if we would finally break out, you know what I think would be the next potential area of resistance? How about 130,000, right? Which is the next 10K increment to the upside. All right, a couple other charts here to wrap up the show. We'll take a question or two. We'll call it an afternoon here on Monday, July 28th. Offense over defense, still very much favoring offense. I showed you the chart about high yield spreads, about volatility. Third thing I would put in that bucket of kind of macro themes that suggest still we're in good shape would be offense over defense. The consumer discretionary sector very much outperforming the consumer staples sector off of the April low, and that's really accelerating here higher in the month of July. This is a number of people have talked about this particular comparison. This is the one that I've developed looking at the cap weighted and then equal weighted ETFs hitting on those sectors. Years ago, I talked with Bill Doan, who ran the Fidelity Technical Research Team. So he was my predecessor back in the 1970s, and they used to look at some old indexes which are no longer available, looking at offense over defense. We talked a lot about how helpful that ratio was getting through the 1970s, going into the 80s, recognizing the strength, the 82, 83, 82 low to the 83 breakout when the Dow finally broke above 1,000, which seemed like an impossible level it may never get above after the 70s. And I fell in love with that idea of looking at offense over defense. And it's been something I followed very closely since those discussions years ago. For now, the market's saying, risk on with offense clearly outpacing defense here in the month of July once again. I thought on a Monday, it would be fun to just take a couple constructive charts and highlight some of the charts that are really starting to work, regardless of what you think about valuations, regardless of what you think about the broad market and the chart of the S&P or the NASDAQ, whatever that main benchmark is for you. Remember that the equity markets are comprised of thousands and thousands of individual stocks, many of which look very, very different than the market as a whole. Nike is one of those charts that I think has gone from a very not good chart to a very good chart. And what has changed on the chart of Nike? Well, we stopped going down and stopped making new 52-week lows. We're starting to go up. We're starting to make new 3-month highs. Now, I think there's still much more for this chart to prove, but I would say we have gapped above the 200-day moving average. We've pulled back to the 200-day, and it is held as support. Now we're rotating higher. So say Nike for now, pretty constructive chart. Could be early on in a much larger recovery. The weekly chart will show you an idea of what that rotation might look like. On the danger side, what do you look for? I actually do have the 21-day EMA. That would be my initial level, right? So, as long as we hold the 21-day EMA on a pullback, anything above there, I consider just kind of noise within the uptrend phase. Watching a potential divergence, right? And this is anytime we make new highs, I glance down to see if those new highs are supported by stronger momentum. Not quite here. It's actually still weaker momentum, but we'll see because we're in an active uptrend, and this certainly could continue to go higher. But on the surface, I would say Nike for now, pretty constructive chart. Saying in that same sector, I mentioned how offense is outperforming defense. Charts like Williams-Sonoma, along with Nike, really showing how improved this sector has become. Williams-Sonoma over the last week, gapping above 180, which means we're clearing the May swing high. We're now above all the moving averages. We're breaking out to a new 3-month high. That's when it popped up on my screen. I think this is rotating back up to the all-time highs from Q1. Strong chart, getting stronger. AMD, I have to give a shout out to the semiconductor space. Look at how this chart has ridden right up the 21-day exponential moving average on the way up. Look at how it rode the 21-day EMA on the way down here with a number of counter trend rallies that failed to get above and hold any gains above that level. When that starts to shift here and we see the RSI consistently below 60, all of a sudden that changes. As we break out above the 50-day, we have the RSI push above 60. That tells us the whole shift is occurring from a distribution phase to more of an accumulation phase. We can see night and day difference from this chart, in the 6 months leading into the April low, really from May 1st on, where now we're above upward sloping moving averages. Now the momentum consistently stronger, the relative performance quite improved. I think that's a strong chart, certainly getting stronger. Energy stocks, it depends on which ones we're looking at. Some stronger than others. I'm highlighting DVN here, very, very close to getting above its 200-day moving average. I'm anticipating some resistance here in the 34 to 37 range. That's the 200-day moving average. That's the first Fibonacci resistance level, kind of this zone here. I'd want to see it get above 37. That's where I have an alert set. And I think if it can get above there, I think that would be a pretty encouraging development. What's happened with DVN is the momentum is sort of sideways. Look how the RSI is ranging between 40 and 60. So it's kind of a neutral chart, not really breaking out, not really breaking down, really caught between the 50 and 200-day moving averages. Let's see if we can resolve this to the upside. Earnings for the energy sector really kick off in earnest on Friday with Exxon and Chevron both reporting. We'll see if that provides some upswing to these other energy names as well. I thought it was DVN that I grabbed. All right, let's take a question or two, and we'll see what we can find here. Yeah, I see some comments about Callum Thomas. He does some really good work. I found him on social media years ago and reached out to him. We've had a great sort of email relationship, and then I reached out to him to ask if we could if he would come on the show, and I'm super excited that he's doing so. So for sure. The World According to Ruben. I love that name of your YouTube account. About 45% of the S&P 500 outperform the index. Isn't the easiest thing to do is to look at the top performers? I mean, yeah, right. And it depends, right? It depends on where we're at in the cycle, how many of the S&P names outperform the index. So what's actually funny is, if you think about what you're saying, and I don't know what time I don't know, I can't validate your data at the moment, but I'm going to assume that you're correct. And I don't know what the time frame is. Maybe that's year to date. I'm not sure. But generally speaking, less than half of the S&P 500 names actually outperform the S&P 500. This is one of the ugly secrets about the S&P 500 index. That's why if you ask money managers, because I worked with them for many, many years, they will tell you it's a nightmare of an index to outperform. It's very hard to outperform. And the big reason is because in recent years, the biggest names have done so well. So the problem is anything you own outside of the Magnificent Seven hurts your performance, because as long as you own Alphabet, Meta, Nvidia, kind of Alphabet, those kind of names, you're probably doing quite well and you're outperforming the S&P. But anything else that you own in any of the other sectors have probably dragged on your performance, certainly in 2025. So even if you have the right market call, even if you're correctly bullish when you need to be, it can be very, very difficult to do. So 100% looking for, just scan for stocks that have outperformed the S&P 500 off the April low. Kudos. Love it. One of the things that you can do on the stock charts platform, I don't know if I have that scan readily available, but I'll share it with my premium members so you can run the scan on your own. But you can actually look for relative performance over a look-back period. So you can say, show me only stocks that have outperformed the S&P over the last month by 5%, by 2%, whatever that is. And I find running that kind of screen randomly can be helpful just to make sure you're keyed in on the stocks that are performing better than the benchmark. Super helpful in a bear market because it's going to help you outperform on the way down. Incredibly valuable in a bullish market because things might go up, but go up less than the index themselves. One other question that I saw in here that would be pretty helpful. Yeah, 3P Investor, thanks as always for watching, and thanks for commenting on the Bob Pisani interview. Yeah, that, asking people about 9/11, I found a very difficult thing. And I really appreciate Bob sharing some great anecdotes, which were kind of chilling and uncomfortable, but very, very meaningful. It was a very personal moment. I was super happy for that. And again, that was one moment among many talking with, it's a great pleasure to talk with someone like Bob, who's just had great experiences in the industry and has met so many people, and having him reflect on some of his lessons learned, I thought really valuable. I hope you guys can check out that interview as well. Folks, that'll do it. We're out of time here today. Some questions I didn't get to, I will put those in the mailbag. We'll do an all mailbag episode on Friday. Now that the soccer tournament that I mentioned over the weekend is over, we're going to be back here in the home office for the remainder of the week, most likely, but happy to provide the show with you every week. Look for that next mailbag episode on Friday. Also, make sure you check out interviews with Callum Thomas, Bob Pisani, Adam Koch, and a bunch of really other great discussions on our Market Misbehavior podcast. I'm Dave Keller with Market Misbehavior, reminding you It's always a good time to own good charts. Have a good night, folks.